terms of the real estate market, people are arguing now that we're in a real estate bubble. What are your thoughts on this?
I vociferously disagree. Who the hell says that?
Everyone on Twitter.
That's so dumb. There's a lot of dumb on Twitter.
Jason strongly rejects the notion that the real estate market is in a bubble, calling such claims largely uninformed and common on social media platforms like Twitter. He points out that the market has actually been experiencing a downturn since late 2021, with falling prices and historic low transaction volume not seen in 50 to 60 years. Contrary to bubble fears, the market is correcting after years of growth, exacerbated by rising interest rates causing affordability issues. Jason highlights the uneven impact across cities. Big Democratic-controlled urban centers like Los Angeles and New York have struggled due to strict policies and socioeconomic challenges, while more moderate or red-leaning cities, such as Miami and Austin, have fared better due to lower taxes and lighter regulations. His analysis stresses that today's downturn is more a reality check linked to interest rates and policy rather than a bubble bursting, inviting listeners to understand the nuances behind market movements beyond social media hype.
No, it's due to policy. It's due to policy.
So what big cities
So the
are
big
doing?
the big cities that had the most draconian COVID policies, I'll use Los Angeles as an example because I live there. They had arguably the most kind of, draconian and tough policies in the country.
Jason places significant blame on local government policies for the ongoing struggles in Los Angeles' real estate market and broader urban challenges such as homelessness and crime. He cites rigorous COVID restrictions, including LAUSD being the last school district to reopen, and lax enforcement regarding homelessness as factors that drove people away. These policies have negatively affected the city's economic vibrancy, housing market activity, and quality of life. Despite massive public spending, $24 billion over 8 years, homelessness rates increased by 40 to 50%, underscoring the inefficacy of existing strategies. He emphasizes that policy choices, not natural urban decline, have fueled these issues, referencing burdensome tax implementations like the mansion tax that have discouraged luxury property sales, decreased property tax revenue, and hindered real estate investment. Jason's perspective signals that, without substantive policy reform focusing on law enforcement, efficient governance, and realistic housing strategies, cities like Los Angeles risk prolonged decline, even if they retain intrinsic advantages like weather and culture.
The mansion tax is another one. The mansion tax.
Explain that for people unfamiliar with that.
So Los Angeles put a tax, and by the way, I can totally see how that tax passed. It's a mansion tax on wealthy people, charging 6% on any sale over 10 million or 5% on any sale over 5 million.
The mansion tax in Los Angeles was designed to raise revenue by taxing high-value property sales, imposing rates up to 6% above $10 million in sale price. While its intention, to tax the wealthy and support social programs such as homelessness, was initially popular, Jason outlines its unintended economic consequences. Sales of luxury properties dropped about 70% over $5 million, drastically cutting transaction volume and slowing turnover, which in turn seriously hurt property tax revenue for the city. Furthermore, sellers who bought homes at high prices often face losses upon sale, yet are still obligated to pay hefty taxes, effectively penalizing ownership despite market dynamics. UCLA Public Policy Research acknowledges the mansion tax has only generated 20% of anticipated revenue while causing economic drag much greater than the revenue obtained, reflecting a net loss for the city. Repealing or adjusting such taxes is difficult in liberal strongholds like LA, resulting in persistent challenges. Jason's critique reveals the pitfalls of poorly calibrated taxation that ignore market realities and disincentivize investment.
So should you buy or rent in 2025?
I think, I don't know, that's a difficult question because it's really location specific. That's a very difficult question. I think it depends on how much personal satisfaction.
Jason advises that the decision to buy versus rent in 2025 and beyond depends heavily on individual circumstances and geographic location. From a purely financial perspective, renting may make more sense currently, especially where interest rates inflate monthly mortgage costs beyond comparable rents. He challenges the common notion that renting is throwing money away, pointing out that homeowners are similarly paying interest to banks. Buyers should not expect significant short-term appreciation and should be cautious about areas that experienced rapid run-ups, like Miami, Austin, Las Vegas, and Nashville, which he predicts could fall another 10 to 30%. Conversely, markets with limited land supply, such as Newport Beach, are more likely to hold value. For those with no emotional attachment and purely financial goals, renting while interest rates remain elevated may be prudent. Overall, he promotes common sense and patient observation until market signals become more favorable before committing to purchases.
Oh, I'm glad you asked. I'm putting it in 30-year Treasury bills.
Okay, so we actually just talked about this. What was that,
Oh,
yesterday? You put
man.
how much into a 30-year Treasury bill?
Well, I put $2 million into an ETF called TMF, which is like a leveraged.
Jason reveals his current investment stance prioritizes safety and yield via long-dated U.S. Treasury securities. He's invested approximately $2 million in TMF, a leveraged ETF that amplifies exposure to 30-year Treasury bills by 3 times, effectively converting it into a $6 million equivalent position. With 30-year Treasuries offering yields near 4.5 to 5%, he enjoys a guaranteed income stream and stands to benefit if interest rates fall, as bond prices would rise, amplifying capital gains. Jason contrasts this with the relatively low yields of Chinese 2% or German 3% long-term government bonds, highlighting the attractiveness of U.S. debt as a safe investment. While he also holds substantial stock positions, especially opportunistic buys during market sell-offs, he views the Treasury strategy as a hedged, intelligent play during uncertain economic cycles where rates could retreat. His investment philosophy emphasizes macro-level common sense over micro-trading or chasing trends, capturing value by balancing risk with guaranteed returns.
Like if someone does a bad job, you can't say, "Oh, you're fired," because if you fire someone, then it's for some
Well, that's
reason.
discrimination.
That's
It's
just a problem with government.
Jason elaborates extensively on the regulatory and legal challenges faced by property owners in California, especially in Los Angeles, that create significant friction and risk in owning rental real estate. Tenant protection laws and local ordinances have made evictions difficult and the rights of tenants expansive, to the point where landlords struggle to regain possession or control of their properties, even if tenants are paying luxury rents. Policies limiting security deposits on furnished homes, restrictions on evicting tenants to sell, and tenant harassment laws increase complexity and potential lawsuit exposure. Furthermore, ADA compliance issues have led to costly retrofits because of aggressive lawsuits filed by attorneys, even without legitimate claims from disabled individuals. Jason also criticizes rent control laws for benefiting tenants in the short term, but damaging investment incentives and housing supply over time, contributing to properties being more valuable vacant than occupied. This regulatory environment leads to legal extortion and discourages investment or development, worsening housing solutions. The overarching theme is that overregulation and litigiousness create an economic environment hostile to property owners, contributing to the city's challenges.
Not a housing shortage. And housing is not unaffordable any more than it was for the last 80 years. If you look at the actual facts, there's actually at least as much housing now per person in America as there has ever been.
Jason challenges the popular narrative of a severe housing affordability crisis by pointing to data that suggests housing supply per capita is at historic highs. He emphasizes that renting a standard 2-bedroom apartment measured over decades has tracked closely with wage inflation, making housing affordability relatively consistent over time. He highlights complicating factors like 2-income households today versus single income in past generations, which impact affordability calculations. Jason stresses that rising monthly costs when buying a home in recent years are largely a result of increased interest rates rather than home prices themselves, noting that home values in some cases have stagnated or declined. He cautions against oversimplified media headlines that stir fear without context, advocating for critical thinking and nuanced analysis to better understand complex housing market dynamics. The overarching message is that the housing issue is often overstated and mischaracterized, without considering long-term data and economic variables.
I've always had a lot of tolerance for risk in my investments. I'm okay losing money. I think in order to make money, you have to be pretty risky. If you're too careful, if you have $1 million today and you are a careful investor, you'll have $3 million in 20 years. And
Jason shares candid perspectives on risk tolerance, wealth accumulation, and personal philosophy around money and success. He embraces calculated risk-taking as essential to significant wealth growth, contrasting cautious investors who may only achieve modest returns over decades. Notably, Jason advocates for spending money as a tool to enhance life quality and happiness, describing money as fun coupons meant to be used. He emphasizes the joy and value of spending on experiences and generosity, particularly investing in friends and shared moments, as some of the highest returns from wealth. On wealth and success, Jason dispels myths of entitlement or victimhood, asserting that intelligence, critical thinking, hard work, and right place, right time opportunities underpin most ultra-wealthy individuals. He highlights the importance of accurate reality perception and incremental intelligent decisions over chasing get-rich-quick schemes. Additionally, Jason stresses the utility of therapy and emotional growth, comparing it to physical training as critical components of personal and professional success.
I honestly, anytime anyone even says the word creative financing, I'm like, shut the f up, get out of here.
Doesn't it make sense if that's the thing that can push a deal through? For example, if someone buys a house 3-4 years ago and they got a 2.5% interest rate, and now rates are 5.5-6%.
Jason expresses skepticism toward creative financing strategies like subject-to deals, where buyers take over mortgage payments without formally assuming the loan. He explains that, despite various structures like trusts or lease options, these arrangements do not transfer true ownership and leave the original borrower liable, complicating risk and legal exposure. Banks can call loans if ownership structures violate loan terms, and upfront payments in such deals are often treated as ordinary income, taxed at higher rates rather than capital gains, undermining the tax advantages of outright sales. Jason prefers standard transaction methods, citing difficulty and risk inherent in creative finance. While such strategies may appeal to motivated buyers or distressed sellers, especially those inexperienced with rentals, the loss of equity control and tax consequences make them unattractive for typical owners. Overall, he favors transparency and advises caution with non-traditional financing in residential real estate.